Welcome back to our breakdown of Michael Saylor's 58-minute Cantor Crypto 2025 keynote. Today we're moving into part 4, and this is where things get intense. This is the section of the keynote where Saylor explains how strategy engineered a completely new class of high-yield Bitcoin-backed financial instruments, Strife, and Stretch, and how these products delivered double-digit yields, incredible over-collateralization, and even triple tax-deferred, all while being built on Bitcoin, powered by AI, and structured like nothing we've ever seen in traditional finance. Saylor calls some of these instruments junk in the credit stack, but then explains why they're actually investment-grade risks once you understand how they're built. This part of the keynote is dense, it's technical, and it's packed with insights. So my job is to break it down, make it digestible, and help you truly understand what Saylor invented and why he believes this is the financial jet fuel and supercharges Bitcoin. Let's jump into Saylor's actual words from the keynote. Here's the section where he explains Strife, and Stretch, and the innovations behind each of them.
And we started by doing a convertible preferred strike. We over-collateralized it. The effective yield was 9, but we realized that it was going to be tax deferred, so the actual adjusted yield goes to 19.7%, which is just off the charts. And then we did another one, Strife, and here I'm describing Stride. Stride's the junior credit instrument. The effective yield's 13%, but it's a ROC dividend, which means you have tax deferral to it. So the actual effective tax equivalent yield is 21%. Okay, it's the crappiest thing in the credit stack. It's the lowest grade one. It's 4.2 times over collateralized. There's not an investment grade company that you can find that's 4 times over collateralized in the conventional, traditional credit market. So we actually have something which is thought to be junk bond or distressed debt, but it's actually an investment grade risk, right? Once you start to study it. And that's, again, a profound insight and a breakthrough. And so, depending on how you look at it, it's anywhere from 2 to 3 times better. Then we created the senior instrument, which is 7 times over collateralized. That kind of sets the cost of capital, and that's 9% effective yield and about a 14% tax equivalent yield. And then we ran into a brick wall because we wanted to do some credit issuance in Japan and Europe, and we were running into some impedance. And so I thought, what can we do in the US? And we started thinking, and we realized that what we hadn't done is a monthly short duration money market instrument. And so a lot of people complain. They're like, well, we want monthly dividends, and we don't want volatility, and we want no principal variation. So we started thinking, how can we do this? And we used AI. We designed this product, Stretch. We took it public in July. It's the biggest IPO of the year. By the way, we've done 5 IPOs this year. 5, right? I don't think anybody's ever done 5 IPOs. The joke that I made is I came up with $1 billion idea in my life, and then I spent 20 years trying to find the second $1 billion idea, and I couldn't find it. And then from the point we found Bitcoin, we found the second, the third, the fourth, the fifth, the sixth, and we started finding $1 billion ideas every 8 weeks. And that's what happened when you combine digital capital with digital intelligence in the right world. So this one came along in July, and the idea is basically you set the dividend every month and you try to stabilize the principal at 100, and well received. And then the deal we did last week is we launched a version of Strife. We launched a perpetual 10% yielding instrument in euros in Europe. And it was about 700 million US, about 620 million euros. And right now it has an effective yield of 12.2%, but a tax equivalent yield just south of 20% if you're a 37% taxpayer if you live in Florida. This is how Stretch has seasoned over the last 12 weeks. So what you can see is it started at 90, we jacked the dividend, and then we took it up 25 basis points twice. And then over the past 8 days, it locked in. Today, it traded plus or minus 5 cents. And today, if you look at your quote, it closed at $100 and 0 cents. And it was trading with 1 penny spreads. You know what we told the market is we're not going to sell it below 100. So if someone wants to offer it to you below 100, you should probably buy it because we're going to get it to 100. And then we're not going to let it drift up above 100 either. So this is our most aggressive piece of financial engineering, because what you see represented in Stretch is us saying we're going to strip 120 months of duration down to 1 month. We're going to strip 50 vol down to 1 if we can get there. We're about 8 now, but probably we're 5 or 3 in the next week or so. We're going to strip that to 1. We're going to convert the basis currency from BTC to USD and take away the currency risk. We're going to take out the delta, and we're going to over-collateralize it 5 or 6 to 1, which is the same as stripping away about 98% of the risk from the instrument. And then we're going to hand that to you as a high-yield bank account. And then we're going to take it public, give you a 4-letter ticker, and let you trade in and out of it in the market, right? And if there's a kerosene for Bitcoin, this is the kerosene. This is the jet fuel. This shows a picture of our digital credit stack over the past 12 months. You can see when I spoke here a year ago, none of this existed, right? What caused this to exist? Necessity is the mother invention. Opportunity in the form of capital and intelligence, not mine, AI, digital intelligence. I argue with the AI and I fight with it, and we learn very, very quickly, and I can get answers that would take 37 accountants and lawyers a month, and I can get the answer in 10 minutes, and so I can iterate something like 100 times faster with AI. So the liquidity in these things has gone from 70 million to 180 million in a few weeks. And let me try to illustrate this a different way. The preferred stock market has normally been a garbage market. Most of these securities are garbage. That they go into a portfolio and people wait to die. They're sold via 144A transactions, which means that it's illegal for the public to buy them unless you're a qualified investor. When they're sold that way, they trade 100,000 a day with a bid-ask spread that might be 300 basis points wide. If you take one public, they trade 1 million a day. The first set of digital credit instruments we created traded 20 million, 20x that. And then when we finally got it right with Stretch, it trades 100x that. And this is 12 weeks old. So our goal here is to get this to 1 billion a day. And it's a chicken and the egg thing. Like, why would I want to trade it? Well, you know, if it's a heterogeneous, low-yielding instrument, there's no reason to buy it. There's no reason to trade it. Because these are perpetual, they're going to last forever. That meant that we could put a shelf registration on them, and we could grow the AUM in the same way that you might grow a proprietary credit ETF. And that was always our vision for this. Now, we discovered that putting Bitcoin together with preferred stock, together with an IPO, together with a shelf registration was an innovation. But then we tripped over this next point, which is we discovered that all the dividends that we pay out are tax-free for you, right? Tax-deferred, technically. Basically, the bug was, oh, you're funding the dividends by selling equity, and you don't have cash flows to fund the dividends. Well, the fact that we fund the dividends with equity means that it's return of capital, which means that all the dividends become tax deferred. And that means that you don't pay New York City tax, you don't pay New York State tax, you don't pay federal tax. You just get the dividend, and the basis in the instrument is reduced. And so a rock dividend is 0% effective tax rate until your basis goes to zero. Then it becomes like a qualified dividend, which is a long-term capital gains tax. And what it isn't is interest income, which is what every bond would be and every money market or every bank credit instrument would be. We thought about it, and then first we thought, well, is this true for all the instruments? And then we said, why is it true? And then it's true because we don't generate substantial earnings and profit, E&P. And then we thought, well, will it continue to be true? And then we thought, well, yeah, the credit's the product. This is going to be true forever. And so the business model is an interesting one once you understand it. And so you sell the credit creates the amplification on the equity, and that's what actually creates the equity value. The more credit you sell, the more Bitcoin per share you create, and that's how you outperform Bitcoin. And the trick is, people have known you could do this, but the trick is to do it without credit risk. So, if I go and I borrow money for 12 months, then I've got a massive credit risk. 5-year money is a credit risk. But if you borrow the money with intention to never pay it back, there's no credit risk. How do you borrow money with intention to never pay it back? You sell preferred equity. So I would love to tell you that I just sat down and we invented this digital credit, but the truth is we stumbled upon it because we kept running into headaches or problems we wanted to solve. And we created digital credit because we started with digital capital. We started using Bitcoin as the collateral asset.
That section right there is one of the most important parts of Saylor's entire keynote, because this is where he reveals the true innovation behind Strategy's digital credit machine. Let's recap what he just told us in plain English. Strike. This is a preferred instrument with a 9% yield, but with tax-deferred, it becomes 19.7%. That's nearly 20% for an investment-grade risk profile. Strife, a junior credit instrument, the crappiest of the stack, as Saylor jokes, but it's 4.2x over-collateralized and behaves like investment-grade debt. The tax-equivalent yield, 21%. Stretch, the big one, a monthly, ultra-short duration, AI-designed, Bitcoin-backed money market instrument with stable $100 principal, monthly dividends, minimal volatility, extreme over-collateralization, and tax-deferred yield close to 20% for many investors. In other words, Saylor is literally describing a high-yield bank account built on Bitcoin, taken public with a ticker symbol, and trading like an ETF. And here's the groundbreaking insight. Strategy discovered that because dividends are funded via equity, not debt, the whole system becomes a triple tax-deferred machine. That means no federal taxes, no state taxes, and no city tax on those dividends until your basis hits zero. This is financial engineering that simply does not exist in the traditional world. And Saylor makes this clear. None of this was possible before Bitcoin. None of this was possible before digital capital. And none of this was possible before AI accelerated the design process by 100x. Whether you love him or disagree with him, Saylor is creating a new asset class in real time. And the fact that this didn't exist a year ago shows just how fast Bitcoin native finance is evolving. In part 5, we'll continue breaking down the next section of Saylor's Cantor Crypto keynote, and trust me, it gets even more fascinating from there. Make sure to subscribe for the full series, and I'll see you in the next breakdown.